Challenging results, weak guidance, and a surprise CEO change. PayPal is at a crossroads after shares plunged more than 20% in just 2 days. So can the new CEO, former HP chief, revive one of the most iconic names from the dot-com era? Let's find out with Adam Frisch, research analyst at Evercore ISI. It's good to have you join us. Thanks so much.
Thanks, Lindsay.
So what do you think about everything we're hearing with PayPal right now? There's so many changes. Some are saying, this new CEO kind of maybe came sooner than expected. What's your thoughts?
I think he did come a little bit sooner than expected, but the prior CEO, Alex Chriss, was on the hot seat for a little while because execution was really, really poor since he got there a little under 2.5 years ago. Now, Enrique is taking over. He was chairman of the board, so all this happened under his watch as well. And if you think about what his track record is and where the pattern recognition is coming, it's more than likely he's going to try to break it up and sell it off. That's where we think the trends are heading, because yesterday on the earnings call, the management team was really just talking about sticking to the same strategy, but just trying to do it better. And that's really not working so well. So we think it's a very mixed up story right now. It's a bit of a mess. And investors, I think this was telegraphed for a little while, but I think the timing was probably a little bit surprising.
Interesting, because that's what I was going to ask you. Is this new CEO here to change things around, or is it just a patch, kind of a Band-Aid solution at the moment? But you say it's more about changing things, I guess, by maybe selling off parts of the company.
Well, he's not a payments guy, and this company needs a payments person, someone with experience both on the merchant side and on the consumer side to help turn it around. They really also need a technology person, because the platform is the main issue, and that's the cause and the root of all the problems that they're having, both with merchants and consumers. I think you categorized the company really well in your intro when you said this was a marquee name back in the dot-com era, and it was. They were a phenomenal brand, great platform, a huge lead ahead of everybody else. But they sacrificed that pole position through a bunch of poor strategy, bad execution, and poor technology, lots of technical debt. And that's why for companies like Apple with their Apple Pay, Android Pay, Shopify with their Shop Pay, firms like Revolut in Europe, buy now, pay later companies like Affirm, all surpassed PayPal because they had a superior consumer UX and better results for the merchant.
Right, because PayPal's core business has really stalled despite years of trying to actually turn around the company. What do you think the company's doing wrong? You just mentioned some of the things that PayPal doesn't really have compared to their competitors now.
If you think about the checkout experience with Apple Pay today, right? Whether you're online, on your phone, or in store, it's really easy. The UX is really very convenient for consumers, double tapping the side of your phone. You can check out anywhere, it knows the address and everything else. You have your default payment mechanism in there as well. Just super, super easy. And very low fraud. So you're supplying in an Apple Pay, and you could also say Android Pay and Shop Pay and the others that I mentioned, are providing a real convenience for the user. And they're also supplying things like, because of multi-factor authentication, biometrics, they're supplying the merchant with lower fraud and higher approval rates. PayPal is charging more for those same services that the merchant is getting with others. Merchants, I think, are saying, why do we need PayPal? Is PayPal critical to our business? And the answer is, unfortunately for PayPal, the answer is no. Consumers have lots of alternatives to pay today. Again, things that are mechanisms that are more convenient and better for them. And the merchants are benefiting from that as well. So I think the underlying cause of all of PayPal's problems come from its technical platform, the lack of integration of prior acquisitions, the lack of really moving with the industry in terms of things like biometrics and MFA, which what I just mentioned. And that led to them being from a superior position in the competitive landscape to one that is completely inferior to others.
So if the company was to explore asset sales, what would that look like?
It's an interesting question. That's what everyone's asking. And given Enrique's background in terms of what he did at HP with separating that, I think that's kind of the logical scenario here, again, because he's not coming in as someone with incredible payments background or consumer marketing and skills that I think the company would need to really turn this around. And if they did decide to turn around, it would be a multi-year attempt. This is not something that can happen in a quarter or two. So I think when you look at the breakup scenario, there are two very logical scenarios. There are two different parts of the business. The unbranded, which is the merchant-facing payment processing side of the company, that's an asset which is fine. It's decent. It's not as good as an Adyen or a Stripe, but it's certainly competitive with some of the legacy platforms out there that are doing e-commerce. We could see that going to a big processor, someone that wants access to that space, or maybe even private equity. And then the second piece of the business, which is the much more important piece of the business in terms of the percentage of profits, is the branded side, and that's the consumer-facing side with brands like PayPal, the checkout button, Venmo, buy now, pay later, etc. And we think Venmo and branded, core branded, the traditional button side, those could be separated into two as well. Private equity is always thrown out there because these entities are not growing, but they do generate quite a bit of cash. But I think that's also could be enticing for platforms that want a consumer asset base, consumer credentials for payments. And that's where I think Venmo is considered the better of the two assets there on the branded side.
So for investors that are listening to all this, seeing the guidance put out by PayPal and looking at PayPal's like long-term value, what should investors should they be considering, really, I guess?
Well, what we wrote in our research note yesterday to investors was we think it's kind of dead money. If this is going to be a turnaround, it's going to take several years, and you're not going to see any kind of acceleration or recovery in 26 for sure. And I would even doubt material improvement in 27, again, because this is a multi-year cycle. First, you have to upgrade the product, then you have to convince merchants to implement it, then you got to go convince consumers that they want to use it again. So this is going to take quite some time if they continue to go at it as an independent entity. If they break it up, the value is in the eye of the beholder. And, right now, it remains to be seen what kind of value potential acquirers would place on the assets. So our target price is $40. We think it's kind of dead money in that range over the next 12 months at least.
All right, we will leave it there. Adam Frisch, appreciate your time today. Thanks so much for joining us.